Robinhood found the back door to Wall Street. It runs through Europe. It runs through a blockchain. And if you read the legal document, it runs through one thing customers do not actually get: ownership. 2,000 stocks, €1 to enter. Open at 2 in the morning. Robinhood just shipped a stock market in your pocket. There is one problem. It isn't a stock market. 3 questions. What did Robinhood actually sell? Why did Europe get tokenized US equities before America? And what would you do differently if you were the next issuer? Here is the thesis. Robinhood did not tokenize stock ownership. Robinhood tokenized the brokerage relationship. The stock market is moving on-chain through exposure before ownership, and Robinhood just shipped version 1 of the wrapper. By the end of this video, you will have a framework you can take to your team. If you are sitting at an issuer, a broker, or an asset manager, Robinhood just forced a roadmap onto your desk. First, what Robinhood actually shipped. On June 30th, 2025, Robinhood announced stock tokens for eligible customers in Europe. It launched with more than 200 US stock and ETF tokens. Today, the EU product page advertises more than 2,000. The retail promise is simple: US equity exposure inside Robinhood's app. €1 minimum, no Robinhood commission, a 0.1% FX fee, dividend equivalent cash payments, trading from Monday at 2 in the morning Central European Time until Saturday at 2 in the morning. That is the retail hook. The technical hook is that these positions are represented by blockchain tokens. At launch, the tokens lived on Arbitrum. Next, Robinhood wants them on Robinhood Chain, its own Ethereum Layer 2, public testnet live since February. So the front end looks like Robinhood. The back end starts to look like on-chain market infrastructure. And the legal document looks like neither. Read the key information document. Product name: US stock/ETP derivative. Type: over-the-counter derivative. Counterparty: Robinhood Europe. Rights: represented by a blockchain-traded token. What it feels like is a tokenized share. What it is, legally, is a contract with Robinhood Europe whose value tracks a US stock. Holding the product does not mean you own the share. It does not give you voting rights. It does not let you redeem into the actual stock. And today, you cannot send the token to another wallet. The token is not the share. The token is the receipt for a contract. The cleanest way to understand this is 2 ledgers. Ledger 1, the traditional market. The Apple share, the Nvidia share, the Vanguard S&P 500 unit. They live in the normal financial system. Robinhood owns them. A US licensed custodian holds them. Ledger 2, the tokenized contract. You enter an OTC derivative with Robinhood Europe. The contract gives you economic exposure. The blockchain token represents your rights under that contract. Order in euros. Robinhood converts to dollars. Robinhood Europe opens the derivative. The asset sits with the custodian. Your app shows a token position. This is why the product is interesting and why it is not the final form. Retail gets a crypto-native wrapper around US equities. But the user does not control the token like a normal crypto asset, and the token does not carry shareholder rights. Robinhood did not tokenize stock ownership. Robinhood tokenized the brokerage relationship. And then the wrapper got tested. Alongside the public company tokens, Robinhood ran a promotional giveaway for eligible EU customers. Tokens linked to 2 private companies, OpenAI and SpaceX. The legal terms said exactly what the public company terms said. Derivative contracts with Robinhood Europe, not company shares. No rights in the underlying companies, not freely transferable. Then OpenAI noticed. Not equity, no partnership, no approved transfer. OpenAI did not say wrong chain. OpenAI did not say bad blockchain implementation. OpenAI did not complain about the smart contract. OpenAI said, that is not our equity. The Bank of Lithuania, Robinhood Europe's regulator, sought clarifications. The press picked it up. The wrapper question got national headlines. This is the whole tension in one news cycle. The wrapper is a derivative contract. The thing the wrapper points at, actual equity, was never Robinhood's to give. Public company tokens did not get a public response from Apple or Nvidia because Apple and Nvidia stock is already on the open market. But the OpenAI moment proved the principle. The token is not the share. The token is the receipt for a contract. And the company writing the share gets a say in what that receipt can claim. So why Europe first? Because Europe gave Robinhood a path the US does not yet give it. Robinhood Europe is authorized and regulated by the Bank of Lithuania. The stock tokens are offered under MiFID II as derivatives. That distinction matters. Robinhood is not telling Europeans these are US securities. Robinhood is telling them these are derivative contracts from its European entity. Zoom out. Europe has been building a broader digital finance lane. MiCA covers crypto asset service providers. The DLT pilot regime created a sandbox for market infrastructure on distributed ledger. Important caveat: Robinhood stock tokens are not themselves a DLT pilot venue. The point is simpler. Europe has lanes where experiments like this can start. America has the bigger prize. America also has the harder market structure fight. So Europe got the product, America got the question. The chain choice is not the usual crypto tribal story. Robinhood started on Arbitrum. Then, in February 2026, it launched the public testnet for Robinhood Chain, an Ethereum-compatible Layer 2 built on Arbitrum, designed for tokenized real-world assets. Robinhood's Q1 report says the testnet has already processed more than 100 million transactions. Mainnet is expected later this year. Infrastructure providers are already integrating. The strategy is clear. The app is the front door. The chain becomes the market structure layer behind it. This is different from what Apollo did with Solana. Apollo picked Solana because the credit fund needed to become usable collateral inside an existing DeFi stack. Robinhood picked Arbitrum because the product is a brokerage surface first and an on-chain asset second. Apollo went where the credit was usable. Robinhood went where the brokerage could control the wrapper. Which brings us to America. On April 25, 2025, Robinhood sent a letter to the SEC Crypto Task Force asking for a federal tokenization framework. Broker-dealers should be able to custody and trade tokenized real-world assets more freely. A modified Form S1, faster ATS registration, a path for exchanges to list tokenized RWAs. Practical, ambitious, and put in writing before the product even launched in Europe. Then SEC Commissioner Hester Peirce put out the cleanest warning label for the whole sector. Tokenization is enchanting, but not magical. A tokenized security is still a security, and if a token does not give legal and beneficial ownership of the underlying, it might be something else. A receipt, a security entitlement, a swap, a derivative, a contract. That is the line Robinhood is walking. That is why America did not get the product first. So if you are an issuer, a broker, an asset manager, or an infrastructure provider, Robinhood just forced 3 decisions onto your roadmap. 1. Decide whether you are tokenizing ownership or exposure. Ownership means the token has to carry legal rights: voting, dividends, redemption, transferability. Exposure means the token can be a contract that just tracks a price. Both are useful products. They are not the same product. Robinhood picked exposure. The next person to ship at scale has to pick on purpose. 2. Decide whether the token has to leave your app. If it cannot leave the app, you control the experience, the compliance perimeter, the liquidity. The token is a customer feature. If it can leave, the token becomes infrastructure. Other venues can list it. Other protocols can use it. You give up control, you gain reach. Robinhood picked closed for now. Robinhood Chain is the long-term hedge. 3. Decide who carries the ugly parts: corporate actions, disclosures, bad prices, market halts, insolvency, custody, regulator questions. Tokenization does not delete those risks, it moves them. Robinhood took them onto its balance sheet. Robinhood Europe is the sole counterparty, and the customer's risk class on the KID is 7 out of 7. Whoever ships next has to decide. Where do the ugly parts live? Robinhood did not tokenize stock ownership. Robinhood tokenized the brokerage relationship. Get those 3 decisions right, and tokenized equities become a real product. Get them wrong, and you ship a green button that says stock, attached to a contract your customers do not understand. Robinhood stock tokens are not the final form of tokenized equities. They are the first retail-scale version of the wrapper, and the wrapper tells you where the real fight is. Not whether stocks can be represented on-chain, they can. Not whether retail wants access, it does. The fight is over rights, transferability, and whether market structure follows the asset onto the chain. Robinhood did not tokenize stock ownership. Robinhood tokenized the brokerage relationship. Europe got the experiment. America got the question. When does a token stop tracking the market and start becoming the market? Robinhood just made the question concrete. The next 10 years of tokenized equities are going to be argued out on this exact split: wrapper or asset, brokerage relationship or share. And whoever ships next has the framework you just heard. Tokenize Weekly,